Right now, something incredible is happening. Every single day, billions of dollars are flowing back and forth between just a few companies, and it all looks like the most elaborate financial scheme in human history. But here's what's truly terrifying. Maybe it's not a scheme at all. And if you think you understand what's going on with artificial intelligence and the investments pouring into it, I have bad news for you. You're wrong, and this mistake could cost you dearly. Listen carefully. What I'm about to tell you in the next few minutes will flip your understanding of the biggest tech boom in the last 25 years, and it doesn't matter if you invest in stocks or not. This will affect everyone. Absolutely everyone. Because when an industry worth trillions of dollars collapses, everyone feels the consequences. Your job, your savings, the prices of goods, everything is at risk. And the scariest part? Nobody knows exactly when it will happen. But wait, what if I told you that maybe nothing will collapse at all? What if the smartest investors in the world see something we don't? They keep pouring in billions every single month. Why? Have they lost their minds? Or are we just too stupid to understand their brilliant plan? Stay till the end, because the truth will turn out to be much stranger than you think. If you ask anybody what they think about the investment market surrounding AI, they're all going to say the same thing. Bubble. Internet bubble. We're in an AI bubble. Bubble, bubble, bubble. And you know what? They're right. We really are in a bubble. And it's easy to see why people think so. The entire market is being carried by a few firms speculating about the future of AI. Every quarter they're playing a game of, say, a bigger number. The products they're releasing are nowhere near covering the costs they're incurring. And every day it just looks more and more like this whole game is being held together by tech CEOs passing around the same pile of money to make their numbers look good. And that's not even the worst part. There's something worse. We're not even talking about the geopolitical risks that could smother this whole industry overnight. The more you look into the current state of the market, the worse the picture looks behind the scenes. The more frightening it becomes. But the most dangerous thing in the world is not what you don't know. The most dangerous thing is what you know for sure that simply ain't true. Think about this. If everybody has agreed that this is a bubble, then why are informed investors still piling billions of dollars into it every month? Are they dumber than us? Or do they see something that regular people don't? Here's what's really scary. I want to say for the record, I think this whole thing is absolutely cooked. Completely. But here's the thing. The best way to really understand something is not to seek out information that confirms your beliefs. You need to look for information that challenges them. That makes you doubt. That turns everything upside down. So let's play devil's advocate. How is it possible that this whole thing is not just speculative mania? How is it possible that we're all wrong? We as a country need these investments if we're going to be the leader in AI technology. Jensen, Nvidia is making a $100 billion investment in OpenAI. The world's top tech companies are pouring billions into building new data centers in the US. It'll be a world of incredible material abundance. A world where individual ability, impact, whatever, is just so far beyond what a person can do today. Sounds beautiful, doesn't it? But wait, don't get excited too soon. Here's what you need to understand about bubbles. Usually they need some kind of outside force to pop them. They don't pop by themselves. Something has to puncture them. Let's remember history. The dot-com collapse was kicked off by a combination of factors, but three really stand out. First, Microsoft was sued for violation of antitrust laws. The giant stumbled. Second, MicroStrategy did a massive revising of their financial results. Their stock fell 60% in a single day. In one damn day. And that got them into hot water with the SEC. Third, a single article pointed out the unviable business model that a lot of companies were running on. Just one article. And everything started falling apart. A few years later, the housing bubble was popped by the subprime mortgage crisis. It was kicked off by rate resets and loan originators filing for bankruptcy. Now think about this. If the AI industry was in a bubble, it's already had plenty of things that could have popped it. Seriously. Look at this list. Market instability around tariffs, legislative controls over AI chips, rising interest rates, legal challenges over training data, organizational shocks, infrastructure problems, concerning studies over business use cases, and what looks like increasingly desperate attempts to generate any kind of revenue. And that's not all. If one article back in 2000 could start unraveling the dot-com bubble, then why aren't the daily articles coming out about the problems in this industry doing the same? Why? What's the difference? So far, at least, the market has pretty much just shrugged all of this off, like nothing's happening. And here's why it's working. The market has been able to ignore all these warning signs for three very important reasons. And when you understand them, you'll start doubting everything you thought before. Reason number one, and it's critically important. Over the last decade and a half, big US tech companies have slowly built up an enormous pile of cash. Incredible, gigantic piles of money. Outside of insurance or financial firms, which are legally mandated to have cash on hand for compliance reasons, tech companies like Microsoft, Meta, Apple, and Alphabet have more cash than any other companies on the planet. They've been saving it away for almost 2 decades. Why were they doing this? Before 2017, tax laws heavily incentivized shifting cash into offshore accounts, primarily held in Ireland. The structures they used to erode these profits into a haven like this were very complicated. But once the cash was there, they couldn't really touch it unless they wanted to pay tax on it. This meant that they just slowly accumulated cash, waiting for something to use it on. And then, something incredible happened. In 2017, these companies were offered a one-time deal to bring back these offshore savings into America for a small tax concession. And that gave them all a lot of dry powder to make some big local investments. Yes, they used a lot of that money to do share buybacks. Yes, they kept a lot of it abroad to fund their international operations. But they also earmarked billions for future capital expenditures. The second reason is even more interesting. For a while, these companies were actually struggling to find projects worth investing in. Think about it. They had become so dominant in their respective markets that spending a lot of money on development was seen as an unnecessary expense that wasn't really worth the risk. Today, that has obviously changed. Completely. The big companies that are driving most of the expenditure on data centers are almost making up for a lost decade where they arguably weren't investing enough money into new projects. And here's what's really important. This also applies to all of the money they're introducing into the system to support less established firms like OpenAI. Sure, the money is getting passed around a lot once it's in the system. But the initial source of these funds is largely coming from piles of cash these companies had sitting on the sidelines. Why does this matter? Here's why. Compared to something like the housing bubble, which was propped up on a lot of debt and rigid derivatives, these companies are at least building atop a solid fiscal foundation. But wait, don't celebrate too early. Having a strong foundation does not guarantee that the house you build on top of it will also be good. Just because these companies happen to be holding on to trillions of dollars doesn't necessarily mean that setting it all on fire to chase one single bet is a good idea. And it definitely doesn't mean that regular investors won't get burned if this money suddenly gets yanked back off the table. The danger is real, and it's close. One of the most concerning trends that has developed in the space is the circular dealing between all of the companies involved in different areas of this industry. We first covered this about 2 months ago. Oracle's stock price spiked after reporting a huge data center rental commitment from OpenAI, who had raised billions of dollars from Nvidia, who made that money in the first place by selling graphics cards to companies like Oracle. See the circle? It closes. They're feeding each other. Since then, the deals have only gotten bigger, and reporters have done a really good job piecing together just how far and wide this web of financial dealings goes. Most commentary has rightfully called this out. Companies are pulling themselves up by their own bootstraps. They're making their revenue look better than it really is by investing in their own customers. Not exactly a sustainable business model, right? But here's where it gets interesting. To play devil's advocate again, there is something to be said about this strategy from a risk mitigation perspective. When people look back with the benefit of hindsight at the dot-com bubble, they all say the same thing. Yeah, the market was dumb. But after a major correction, there were still some big winners that emerged. Some of them being the same tech companies involved in the AI market right now. Nvidia investing into a company like OpenAI right now looks a little bit suspicious. But if AOL had invested in Amazon back in 1999, we would probably be a lot less critical. Think about this. By investing up and down the supply chain, if you could call it that, these companies are in theory maximizing the chance that they will capture the value eventually generated through AI. There's one other really important detail that a lot of people gloss over when exposing this financial circle. It's easy to look at this and conclude that this whole market is just a Ponzi scheme propped up by investor hype. But here's the problem with that conclusion. They aren't really taking investors' money. Not net. The major players in this industry are paying out far more money through dividends and stock buybacks than they are taking in through stock issuance or borrowing. Compare this to the dot-com bubble. The story was very different. Hyped companies were dependent on bringing in a continuous stream of investor money to keep the lights on in businesses that made no profit. Often, they didn't even make any revenue. At all. A company like OpenAI is also in this position where if they don't keep on bringing in new investors, they won't be able to continue operating. But they are not raising money from regular investors. They are primarily getting it from companies that have plenty of cash to invest. And here's what's funny. I'm not going to say I feel bad for big tech companies, but nothing they do with their money right now is going to be popular. If they make capital investments into data centers, people will say they're blowing their money on chips that will be obsolete in 2 years' time. If they buy their own shares, people will call them out for driving up demand on an already overvalued stock. And if they buy shares in other companies, people will call them out for circular dealing. Yeah, I know. I'm sure they're truly devastated. With all of that said, that doesn't mean that these companies and the wider economy are completely safe. No, not at all. Here's the real threat. Share prices are clearly elevated on the expectation that AI products and services will eventually bring in trillions of dollars to major participants in this industry. If this doesn't pan out, then those prices could be reconsidered very quickly. Catastrophically quickly. The major incumbent players aren't at immediate risk of collapse because they still have far more cash than debt, and they still have functional parts of the business to fall back on. But their biggest risk is this. If this does go to hell, they will have to explain to their investors why they thought it was better to spend hundreds of billions of dollars on redundant data centers instead of just paying out that money to them. Imagine that conversation. Sorry, we spent $500 billion on something that didn't work out. Nobody can truly predict what the future of AI will look like. Nobody. Even the CEOs themselves have admitted that. But here's how they're framing it. They are betting $500 billion on a dice roll. If it comes up 6, they will make $10 trillion. It's a risky bet. But that doesn't necessarily mean it's a bad bet. Risk and reward. Classic story. Oh, and here's what takes the sting off. They know that the government will probably be there to comp them some chips if they just keep the game going. But we don't say that part out loud. So what does all of this mean? If you're still not convinced, don't worry. I'm not convinced either. But here's the thing. Maybe we're both wrong, or maybe we're right. But it doesn't matter. Because at the end of the day, when trillions of dollars are at stake, the rules of the game change. And the ones making those rules aren't you and me. Remember the main thing. The most dangerous thing is being certain about something that turns out to be untrue. And right now, everyone is certain they know how this will end. History shows that when everyone thinks the same way, reality usually delivers a surprise. The only question is, will that surprise be pleasant or catastrophic?